Wish stay on. We'll have a couple of more questions for you. Sandeep Shah is also joining us now, Associate Director at Motilal Oswal Private Wealth Management. Sandeep, hi, good afternoon. So, interesting because the market has gone through a mid-cap capitulation. There's just some bit of stability coming back into the mid-caps. Do you reckon the worst of the price damage is out of the way?
Well, yes, the mid-caps have been falling on extremely thin or perhaps even very little volume. So in that sense, the prices are not really representative, but then that in any case tends to happen in mid-caps. And in fact, the last time I was on your show, I had mentioned that the Nifty target of 11,000 to 11,200, and we've corrected exactly from the midpoint of that range, 8 days on a trot. And I think the Nifty has also, I think, broadly taken support at my initial target of 10,400 to 600. I had mentioned the last time I was on your show that while I found mid caps and small caps attractive even then, and we've seen us collapse post that as well, I mentioned that outperformance may happen only post budget. Post the election outcome. And to that extent, I think I would change my stance given the further sell-off in small and mid caps, that I think those who are brave-hearted, I think, should certainly begin buying now. You can scale in your purchases. This is something that I maintained last time as well. I think you can scale in your purchase from now till the election outcome. And the reason that it's important to start buying now and not wait is for two reasons. One is investor behavior and investor psychology. The point is that even if we have a negative election outcome and there is a knee-jerk reaction, markets will most certainly do well post that, as we are aware of, and it's unlikely that investors will end up buying during that sell-off or that knee-jerk reaction if it happens. What is on the other hand is possible is that the market already prices in the election outcome, and post-elections we see a rally. So therefore, the time to buy is now. At the same point of time, we have 4 or 5 months till the election outcome. So we can actually scale in our purchases in that. So yes, I'm now saying that even though outperformance may take a little while, clearly we should be buying now.
Okay, that's interesting. But that buying call, does it extend to sectors like, let's say, auto as well? Because that's where there's so much of gloom and doom talk still going around. We were just discussing Ashok Leyland before you joined in. Or a stock like, franchise like Eicher, Maruti, are these good levels, or do you think there's still several months of pain in terms of demand and therefore maybe even stock price action?
So in fact, the last time I was on your show, I told you that I would not buy auto now and I would actually wait to buy. And auto stocks have corrected since then for good reason, as you've mentioned that some of those companies have disappointed on the volume numbers, and it's no longer company specific disappointment. I think across the board, whether it's two-wheelers, four-wheelers or commercial vehicles, there is a clear slowdown and very palpable, and it's also feeding in through the system in terms of affecting auto ancillaries and so on and so forth. And while part of the reason has been higher prices of some of the products due to various reasons, and also to some extent lack of funding which is happening for purchases, especially where the smaller NBFCs are associated with. Having said that, I think further corrections from here, I think, should be a buying opportunity. I think the chairman of one of the largest four-wheeler companies actually mentioned that we tend to see pre-elections, we tend to see a slowdown, pre-general elections, and a surge in volumes post that. While the logic is not entirely very clear, but it does suggest that in general there is a softening of confidence, and there is a general a postponement of decisions pre-elections, whether it's businessmen, and therefore affecting consumers as well. So yes, there is a buying opportunity which is going to come in auto in the next 3 to 6 months, and we should be looking at further corrections to buy some of the top quality names, leaders in either their individual spaces or leaders in the overall segment as a whole.
Okay, fair enough. What about some of these, haloed consumption names which are correcting? Page Industries, for example, is now down 40%. Some would argue still expensive. In fact, you can't even argue it is still expensive. You have Jubilant Foodworks, which has corrected from its peak. On the other hand, there's a Bata which is still making new highs, but there the earnings were really spectacular. But overall thoughts on this space?
So, there has been a lot of pain in individual companies, and I think individual traders as well as investors have got hurt. And I think what tends to happen is that as the market correction continues, and I'm not talking about the headline Nifty here, I'm really talking about the broad market. And as the correction there continues, I think investors start taking profits in other companies as well, because a lot of the small and mid caps, it's very difficult to sell today. I mean, and it probably doesn't make any sense, because the prices are not even representative, have absolutely no correlation in some cases with the underlying value, simply because they're down on just because of very small volume. So therefore, I'm not surprised that on a little bit of bad news, you've seen fairly sharp correction in some of stocks which have been holding up very well and have been doing well. I would of course like to highlight here that when we look at P multiples of growth companies, I think it's also important to look at the longevity of growth, and that's something that a lot of investors find it difficult to factor into their assumptions. Some of the very high P stocks, while they have what looks like reasonable growth at 20-30%, perhaps the runway of growth is so long, which is why the multiples tend to be higher. But yes, I'm not surprised at the correction, and I think that you could see individually some of these stocks continue to correct. But then the good news is that as the market correction draws towards its final legs, it's the quality stocks, it's the leaders of the market so far which correct last. So therefore, it's actually a welcome sign.
Okay, so just getting back to the point specifically on consumption, Sandeep, how are you cutting the basket? Because I mean, there is something like Page that continues to get derated, as Anuj pointed out. Bata is still finding takers. Within staples also, it's such a mixed basket. I mean, Lever, for instance, doing much better than a Godrej Consumer last 3-4 months. Godrej Consumer has come off quite significantly from the highs as well. So now how do you cut the pie?
So clearly, I think while broad cut consumer stock valuations are on the higher side, again the longevity of growth for some of these companies seems quite high. And to be very honest, I think it's also a fact that there aren't that many quality businesses which are growing which you can buy. That tends to put a higher premium on some of these consumer stocks. As far as FMCG is concerned, I think I would continue to be positive here. Clearly, there will be differences in performance based on which companies are gaining market share, which companies are losing market share, which companies are more domestic focused, which companies have more of an international business, which could be more volatile. So I think we'll have to incorporate that, and you can't paint everything with the same brush, because at any point of time there are always companies which are gaining market share. But I think the volume growth of most of the FMCG companies has been very good, and I don't think we can complain upon that at all. Perhaps on the margin side we could have, but as long as there is strong volume growth, and with the spending that political parties are likely to do ahead of the elections, you will see more money in the hands of the lower strata of society. And I think so FMCG companies volume growth, I think, should continue to remain fairly good. So I would continue to be bullish on them. At the same point of time, highlighting that returns may be fairly modest. On the discretionary consumption side is actually where there has been a lot more pain. We've seen that in consumer durables. What is also happening is that some of these companies have re-engineered their business models. So there are some companies which are doing very well today, but those companies weren't doing so well 2-3 years back. So ideally, from an investor's perspective, what you really want to buy is a business which can continue to grow very well for the next 5-7 years and longer, and not just businesses which keep changing their strategy every 2-3 years, and sometimes they get it right and sometimes they falter, and you're hoping that every time that things falter that they will change their strategy and do that. You don't really want to buy those businesses. You want to buy those businesses which companies have been doing, have capable management, a proven business model, and have delivered consistent performance. We can live with shorter periods of subpar growth, as long as the longer term trajectory is very clear. So you've got to be careful there, because worth highlighting again, there are companies which do well for 2-3 years, fall by the wayside, again need to rechange their strategy, again come back, sometimes they don't, and you, as an investor, you could be left holding the bag. Okay, Sandeep, we leave it there today. Thanks a lot for joining us and giving your opinion. By the way, look at the market. All of